So, good afternoon. I hope you had a relaxing lunch, especially a nice chat with new colleagues, and you got inspired for this session of this afternoon. And today we're going to talk about measurement of progressivity of the tax system. And for those of you who don't know me, I'm Chiara Bronchi. I am a practice manager in the for the Fiscal Policy and Sustainable Growth Unit at the World Bank, and we are anchored in the Global Vice Presidency for Equity Finance and Institutions. And with this, let me get into the topic, and then I will introduce our panels, and also I will give a bit of rules of the day in terms of timing. So first of all, I think we had yesterday there were many references to issues of progressivity of the tax system and also fairness of the tax system. And while there is a strong need for fiscal consolidation in many countries following the multiple crises, I'm not going to repeat that, but tax system have also need to achieve broader goals. And I think it was also set up very nicely yesterday from some of our speakers in the plenary, but also in some parallel sessions. Tax system can also be progressive, while of course public expenditure has an important role. But the reason why tax system can help, we need to look at the progressivity of tax system, and I'm talking about tax system here, not just one tax. It's because they do contribute to the fairness and redistributive objectives of countries, and also in terms of prosperity and shared prosperity, which is one of the key objectives of the World Bank. Now, I think what we also learned, and Mario was very clear yesterday, was that many tax systems in developing countries currently exhibit very little progressivity, relying heavily on the indirect taxes and raising relatively little revenue from key sources of progressivity, such as personal income tax, capital income taxes, and property taxes. So as countries look to raise tax revenues, it's therefore important to also look at how tax reform are implemented in ways that are also more fair. And more broadly, it is important to note that it is overall the progressivity, as I was saying, of the tax system that matters. So, in this context, we at the World Bank, like many other partners, are looking very closely at this area, and it's particularly, it's certainly in many ways joint effort with our poverty group, but we are really focusing on looking at the progressivity of the tax system across the entire income distribution, and we feel actually there are still a lot of gaps that need to be analyzed in this regard, and that's why we have decided basically to invest in a stream of work on progressivity. And I think actually, I don't want to take too much time because I know that Alastair, who is one of my key team members leading on this agenda, is going to give a short presentation to set the stage. So let me introduce now, let me say just a few things, two things we want to look today. So we're not going to talk again about what you heard yesterday, but it's more about methodological approaches, challenges with that, and also which metrics of productivity are currently being used. And so that's what we want to discuss today, basically. It's going to be fairly technical. Now turning to the panelists. So next to me is Wynnona Steyn, and Wynnona is an economist in the South African Revenue Services. Welcome, Wynnona. And then we have online Charles Vellutini, senior economist at the IMF. Charles, welcome.
Yes, hello, good morning. Thank you.
Hi, good morning, Charles. Charles is connecting from Washington. And then we have Alastair Thomas, a senior economist at the World Bank, and Jon Jellema, senior fellow, fiscal policy and development at GDN. So welcome all, and we're all looking forward to this discussion. It's 2:25. I'm well known for not maintaining the time, but I will make an effort. because I think it's important to also give time for questions. So we have 4 panelists. I think it's important to, let's try to keep it 12 minutes each, max. And then we will open for questions and answer sessions. So let me turn now to Thomas. We agreed with Thomas, he will provide an anchoring for this conversation today. And then we'll move on to Charles, and then Jon, and then Wynnona. Thank you. Alastair, the floor is yours.
Thank you, Chiara. I think we're still working on the slides, is that right? Well, I will start, and I will hope that some slides will appear in the very, very short future. Yeah, so as Chiara said, I'm really going to try and provide a broad sort of overview of the ways in which progressivity can be measured, and the associated issues and methodological challenges, really to set the scene for the far more interesting and detailed discussions that my colleagues here on the panel will go into more detail on. Oh, look at that, perfect timing. Thank you. Okay, just to give you a quick idea of what I'll talk about. It's not showing? Oh.
It's not showing on the screen. Oh, he's going to make it happen.
Ah, fantastic.
Thank you.
Okay, well, I've largely covered the slide, which is just an outline of the presentation. Again, it'll mainly focus on approaches to measuring progressivity, and then on some of the challenges and complexities. I would like, because my panelists will not delve into the last issue at all, I want to briefly talk about the use of aggregate tax data as well, just because it's a very blunt instrument, because you can't distinguish rich from poor when you're looking at aggregate tax data, but it can be useful at a higher level to at least have a better understanding of the degree to which countries use types of taxes that are typically more or less progressive. So it can provide some useful high-level messages as well. Okay, Chiara. Okay, so when we think of progressivity, what are we talking about? I mean, the basic definition that we'll think about is that the average tax rate should be increasing across as income increases, or as the particular welfare metric that you've chosen increases. Now, the early research in the area was really focused on personal income tax, but even then, it's not quite so simple because with a typical personal income tax, it has a progressive tax schedule that's a core part of the design. So a question there immediately becomes, well, when you're saying progressivity, what are you interested in exactly? Are you interested in the progressivity of the tax schedule itself, or potentially in combination with any deductions and credits or associated with that? Or are you interested in the progressivity of the taxes actually paid? And the distinction between the two here is, of course, is the underlying income distribution that links those two. So going back to the 40s, Musgrave and Thin is the classic paper that labels these as structural progressivity as compared to effective progressivity. And so structural progressivity then is you'll look at, say, for example, average rate progression, which will just look at for a particular increase in income, how does the average tax rate increase? The thing about that is that, of course, that's a measure of progressivity at that point in the income distribution. So it's a local measure of progressivity. And if you're interested in comparing across countries, or if you're looking at the overall impact of the particular tax, then that local measure is potentially, not as useful. Of course, it has many attractions in that it's very simple to calculate. You just need the progressive tax schedule, the rules themselves, and you can do the calculations. But again, it has that limitation in terms of cost. So if we think about effective progressivity measurement, then we need microdata. We need data that's distinguishing poor from rich, and to be able to calculate tax burdens across that distribution to undertake calculations. So the cost is it's a lot more data intensive. The benefit, of course, is you are now incorporating the income distribution into the analysis. And that's pretty crucial when you think that you may have a progressive rate structure, but with a very high top marginal tax rate. But if if there are only like 2 people at that point in the income distribution that are paying that top marginal tax rate, then it's really not having any significant impact on the progressivity of the system at all. So having that income distribution is a crucial benefit. The other aspect of why this is really useful is that it enables you to calculate some global metrics of progressivity as well, which I'll touch on shortly. The final thing is an alternative, a more recent alternative that's come through sort of from the early 1990s onwards, is this idea of progressive capacity. And that's kind of a hybrid approach between the structural and the global, structural and the effective progressivity measures. And that it's trying to use it wants to calculate a global metric of the progressivity of the entire tax. But the focus of the analysis really is on the tax structure itself. And so the early papers there would basically try and use a fixed income distribution to sort of hold constant the income distribution, and then calculate the global metrics of progressivity to undertake the analysis and comparison across countries. So those are the broad different types of approaches that can be followed. I was going to just give a little bit of background on the most common global metric, but given Chiara's already stolen 3 minutes away from my presentation, I don't think I'll go into detail on this, other than to just say, if you think of that average tax rate, the increasing average tax rate sort of concept of local progressivity, the Kekwani Index really is just an extrapolation of that to a global context. So the average tax rate increasing is just really a measure of a deviation from proportionality. So the Kekwani Index is then really, it's calculating a global deviation from proportionality. So it's looking at the difference between, well, it's effectively asking how much more unequally distributed is the distribution of taxes as compared to the pre-tax income distribution itself. And that's that global metric. A really interesting point is that you can look at, by using these global metrics, you can look at the overall redistributive impact of a tax. Broadly speaking, ranking issues aside, the difference between pre- and post-tax Gini's. And with this kind of framework, you can decompose that into the progressivity impact on redistribution and the average tax rate impact on redistribution. And I think that's a really nice thing to be able to do, and it goes back to some of the discussions yesterday, because you will see that some countries can actually have quite a progressive tax schedule. Some developing countries effectively are not taxing the bottom half of the distribution at all, and maybe the top decile actually pays quite a bit. So in terms of the pure progressivity, this is quite a progressive system. But the amount of tax revenue being raised, and so the overall average tax rate will be just so low that despite the progressivity, you're really having no redistributive impact. And so with these global metrics, you can do these very interesting breakdowns in the analysis. Oh, going the wrong way. Okay. In terms of challenges, I think coverage is a really key issue here, and that, obviously, as Chiara says, we're interested in the progressivity of the entire tax system and embedding that within the entire fiscal system as well. But we're limited by data in terms of what we can cover, and we typically tend to be, this is why you see most focus on the personal income tax where data is available, and an additional focus on the VAT and potentially excise taxes where consumption tax microdata is available. In order to do the kind of analysis that we need, which, as you see on the slide there, we need to be able to rank individuals or households, from poorest to richest, and then we need to be able to assign tax burdens across that range. But when you start looking at some other taxes, it becomes difficult, not just potentially because of the lack of data, but also, you run into incidence issues as well. So, for example, with the corporate income tax, the literature is very much still open as to, exactly who bears the burden of the corporate income tax. Is it completely capital owners? that bear the burden, or what part is borne by consumers, what part is borne by workers. So you see some analysis, some recent research for the United States, for example, will sort of make an estimation that maybe 60% of the corporate income tax is borne by capital owners. And then if you have good administrative data, for example, you can then map that corporate tax burden to those capital owners who are reporting dividends, in their tax return data. So there are ways that you can start looking at the corporate income tax, but it's several levels of more complication, and that becomes very, very difficult. Wealth and inheritance taxes, other taxes where we would typically expect these to have quite a strong progressive impact. Again, if we don't in the absence of administrative data, if we're really not getting information from survey data on the tax bases here, so it becomes very difficult to actually have a metric for their progressivity. Finally, the range of other data issues when we look at the look at the microdata itself. So if we start with sort of income survey, expenditure survey microdata. So obviously you have the typical issues with survey data in terms of sampling, non-sampling errors, particularly even more so, say, with if you're using consumption data where, this might be underreporting. So if you're trying to model the distributional impacts of tobacco taxes or alcohol taxes, people are likely to underreport their alcohol consumption and so on. So the various issues here. A really big issue, though, particularly with income survey microdata, is potential underreporting at the top end of the income distribution. So that's a key challenge that we face when using income survey microdata. Another one in developing countries, income survey data is often just not available. So the majority of the analyses that the World Bank has been undertaking as part of the broader CEQ work is focused. It has to use expenditure survey microdata because that's all that's available. Now that's actually quite useful for modeling the distributional impact of the VAT because consumption is the base of the VAT, but it's not the base of personal income taxes or any transfer payments. So you have a problem here in terms of you're using consumption to proxy for income. You potentially need to try and make some adjustments for the savings behavior, which is the difference. And so added levels of complexity here. Also with survey data, if you've got a schedular tax system that applies, well, if you have a comprehensive tax system, then things are going to work okay. Labor income and capital income are bunched together and taxed at the same progressive rate schedule. So you can model that, and if the capital income is captured in the income survey data, that's, you're from a good starting point. But if you have a schedular system where capital income is taxed at different rates to labor income, and typically that will be at lower flat rates, then you can't really model that in your micro simulation model because you can't distinguish the labor income from the capital income. Administrative data, tax return data, this starts to create some possibilities to address some of these problems. So you're immediately getting much better coverage of the incomes at the top income level. And potentially of capital income as well. In your micro data set, you'll have a different column. If there's a different tax rate applying to types of capital income, you'll have a separate column with the income, that capital income that you can then model the differential tax rates for. So that's a great benefit. But at the same time, there are costs in terms of, your tax return data is the data from the taxpayers. So you're missing the zeros at the bottom of the distribution, the non-taxpayers. So if you're interested in the distributional impact of the entire tax system, the progressivity of the entire system, you want to take account of the non-taxpayers at the bottom end of the distribution as well. And so you face a challenge with administrative data there. Then you can start looking to combine both, so you can use administrative data to help make adjustments to your income survey data. So various approaches here. And Wynnona will talk a little bit more about the use of administrative data versus survey data later on. Final point just on that is that informality becomes challenging to take account of. I mean, there are ways, for example, with VAT that you can look to account for informality. Difficult with income tax, and even with tax return data, microdata, this is the declared data. This is not necessarily the actual data. So for example, high income individuals might be interposing corporate structures and so on. So the actual the actual income figure that is reported in the personal income tax paid is not necessarily their true income. So broader issues here that we struggle to capture with the analysis. Final point when we look at progressive capacity measures is that you can get ranking issues if you use just a fixed income base, then there's a risk of rankings changing as you're trying to compare across countries and you're trying to focus just on the structure of a progressive personal income tax. If you just pick the specific income distribution you've used as the base for your analysis can have an impact on the cross-country rankings you might get. And so there's been work recently done to try and develop new methodologies to try and address that ranking issue. And Charles will discuss some of his recent work looking particularly at those issues, again, in terms of analysis of progressive capacity. So I was going to briefly talk about the use of aggregate tax data, but I've got 1 minute. Okay, excellent. I can talk about it then, great. Just to make a point that the whole message here is that in terms of scope, we do become limited, particularly by the data constraints. So a lot of analysis does focus on the personal income tax or the VAT. Having a look at aggregate tax data does at least allow you to take a step back and have a bit of a useful picture of the overall tax system. And so this graph here is just showing, there's 2 bars for each of these groupings of countries from highest income countries to lowest income countries. And each bar is showing direct taxes versus indirect taxes. And so you get some nice messages here that you see on the far right of your screen. The lowest income countries really relying vastly more on indirect taxes as compared to direct taxes, and going across to the left of the screen, and it's not just high income countries, it's really the very highest income countries are the only countries that really start to rely most heavily on the personal income tax, which is typically the most feasible area of achieving progressivity in tax systems. So you are able to pull out some of these messages here from the use of aggregate tax data. But again, it's a blunt instrument. We can't produce a Kekwani index or a Reynolds-Smolinski index of redistribution, really detailed kind of analysis. This is kind of just a take a step back, a broad approach to get an idea of the overall situation that we then need to complement and to go into detail with the analysis that we are able to do dependent upon the data that we do have. So I'll stop here, and I look forward to the delving further into these issues from the other presenters. Thank you.
Thank you, Alastair. Charles?
Thank you, Chiara.
Do we need to change the presentation?
Yes, I'm going to share my presentation, but I don't think I can because sharing is disabled now. But I sent my presentation. Maybe you can share it from Clermont, and I can...
We can move them. We'll load it and we can move them forward for you. Just tell me next slide.
Yes, thank you, Alastair. Thank you. That will be great. Okay. Well, in the meantime, let me say that I'm very pleased to be with you. I wish I was able to be there in Clermont, but still it's a pleasure to join remotely. Yes, I can see my slide. Thank you very much. So I am Charles Vellutini, and this is joint work with Juan Carlos Benitez. We are both at the Tax Policy Division at the IMF here in Washington. So this is very much work from staff ourselves, and does not represent necessarily the position of the institution at this point. So we're going to talk about how to measure redistributive capacity of tax policy, with a focus on the personal income tax. If I can move on, the next slide. Yes. So I don't think we need a lot of on how to motivate you on the topic, right? I think clearly accurately measuring the redistributive capacity of tax policy is super important, and is different, and is a complement to looking at how much revenue we're going to raise with the tax system. As Alastair pointed out, it's more difficult than possibly is thought of. In terms of data and computation, it is rather demanding. And certainly, as was pointed out, just looking at how average tax rate increase with income is not enough, right? You want to have a look at the effective redistribution because at the global level, and because those how the schedules of taxes interact with pre-tax income distribution is key. As Alastair said, if you have only a few taxpayers in a bracket which is with a high rate, you're not going to achieve a lot of redistribution, right? So a key point here is that if you want to measure this thing accurately, you need income information on the pre-tax income distribution. But then the consequence of this is that what happens if you have, for example, a very spread distribution, it will mechanically strengthen the apparent equalizing effect of an identical tax policy configuration and vice versa. Think of, for example, in a situation you would have a perfect equality, a Gini coefficient of 0. I mean, there is nothing else to redistribute, right? So any policy, any tax policy using that distribution will look equally, powerless in terms of redistribution. So we have these problems that we need to measure and compare, intrinsic redistributive capacity, holding constant or controlling for pre-tax income distribution. Moving on to the next slide. So there have been two basic solutions commonly used. The first one has been quoted by Alastair again, so I won't spend time on this. It's a so-called fixed income approach, which is just using an arbitrary, identical pre-tax distribution and use that distribution for all of the tax system you want to compare. Of course, I mean, you have the issue that this is not robust to the choice of that redistribution. The rankings of your indexes will depend particularly on your choice of this fixed income, right? For example, with a famous study on Germany, the UK and Denmark, that uses Germany as the pre-tax distribution. But of course, if you choose Denmark, you have different ranking of the power of the redistributive power of this free tax system. So we have this problem, right? So in 2002, Dardanoni and Lambert published a very important paper, landmark analysis. I know you can develop a much more rigorous approach, which is called the transparent and compare technique, where all the system are transplanted to a common base. So you don't need to choose a specific pre-tax income distribution. They are all transplanted, okay? The problem is that it is very demanding in terms of microdata. It is also very computationally demanding. So this is probably why you haven't heard of this approach. It is very demanding. So the contribution of this working paper and this presentation here today is to show that we can have a simplified approach to this transparent and compare technique using simulation-based implementation of that. So moving on to the next slide, we're going to talk about the methodology. We can skip that because Alastair presented the indices we're going to use. Yeah, next slide, thank you. So let me briefly give you the gist of what this transparent and compare procedure is about, right? If you consider two tax regimes you want to compare, which one is more redistributive than the other? You're going to transplant one into the other one by transposing both the pre and the post-tax distribution of one, let's say I here, into a J, and the end result is going to have the indices, the Kakwane index plus the redistributive index comparable because they're now being transposed into a common base. We'll see in a minute how it is done in practice. But the key message here is that this normally requires full microdata of both distribution of the two regimes you want to compare, the microdata of I and G. So in some instances, you will have that microdata, but very often you won't, right? You just don't have the microdata. Think of a technical assistance situation. Well, you have possibly microdata on the country you work with, but certainly not microdata on all the benchmark as the other country you want to compare that country with. Okay. So the idea, the contribution here is that, hey, but we have more information on the Gini, for example, of many countries. We have decile information also, not, and that can be used, right? So we know things about pre-tax distributions, not necessarily the full microdata, but we have very important information on the shape of the distribution. If you combine that with assumptions on parametric distribution, for example, if you assume that all distributions are log normal, and it's not a bad assumption. Log normal have been shown to be very efficient in reproducing, in approximating conveniently real distribution. Then there's a lot you can do. Moving on to the next slide. The simplified simulation-based implementation of the transplant and compare method is like this, and it is much simpler, and you don't need microdata. So very briefly, first, you're going to calibrate your pre-tax distribution for any country, and you can do that by using Gini coefficient and a mean of that income distribution, for example, GDP per capita, okay? And again, you do have now a lot of information on many countries and many years on Gini coefficients. Then you're going to simulate, which means you're going to create artificial simulated taxpayers. And on this, you're going to have a pre-tax income distribution, and then you're going to apply your tax schedule to this distribution. You're going to end up with a post-tax income distribution, also simulated, right? And then you're going to transplant all this simulated distribution to a common base distribution. And you're going to use, this transplantation will need to have certain properties. We don't have to talk about that, but they need to be isoelastic. The end result is that you will be able to compare redistribution and progressivity indices of any regime transplanted into the common base safely. And again, you didn't make a choice of a specific distribution. They all transplanted into a common base. And the choice of that common base doesn't matter, right? It can be any common base. You will have the same ranking because they all been transplanted. Moving on to the yeah, thank you. So let's very briefly, I know I'm running out of time, so let me briefly show you how it matters to do that. You have on the right side of the screen, the distribution of the Gini coefficient, so this Gini vary a lot, right? So if you don't correct for the shape of the pre-tax distribution, certainly you're going to be making wrong measurement. So this is just, a reminder of that. There are a number of databases available. One of them is the Standardized World Income Inequality Database. There are others, such as the Worldwide Inequality Database. We use here the one which is on the screen. Moving on to the next slide. Of course, we have caveats to this exercise. First caveat is the log normal, which is presumably relatively simplified assumption. Is it enough? I mean, is it good enough to have meaningful comparisons? It can be tested, and we have done so. You have, of course, the option of using full microdata for those countries where it is available, and to compare with the simplified approach. We're going to see that in a moment that in fact it is acceptable. But of course, you can still improve on that, and this is ongoing work here at the IMF on this. And the second caveat is, especially on the PIT, GDP per capita include elements which are not taxable. So here again, you can test it, whether it is an acceptable approximation, and you can certainly improve on it, and there are sources where it can be indeed improved. So moving on to the next slide, please. So let's look at the results we have on the PIT. So first, we compare here the result from our simplified approach with the full approach of the transparent and compare technique, okay? So the message here is that it is acceptable, but of course, whenever you have microdata, it is better to use it, right? And if you have the resource to compute it, to process it, it is better to do so. So on the left side of the left-hand side of the screen, you have the redistribution index, and you compare the two approaches, the full approach and the simplified approach. So you can see they are very, very close and certainly extremely strongly correlated, but they're not identical, right? So it is acceptable, and certainly it is better than doing nothing, right? If you have microdata using this Gini-based approach, simplified approach, is better than nothing, but again, it is not exactly identical to the full, using to the full microdata. And the ranking on the right hand of the screen are also very, very close, but they're not identical again. So it's better to use microdata, but still it is acceptable to do it and better than really not correcting for the difference in pre-tax distributions. So moving on to the next slide, I'm almost finished. I want to now to show you, what kind of result you have when you use this approach, which is again now controls for the pre-tax income distribution. So you're not making errors on this. It is meaningful comparisons you're using here. So the graph on the left shows how you have multiple ways to achieve the same redistributive capacity. As Alastair said, right, redistributive capacity is made of, on the one hand, the progressivity of the system, which means how concentrated taxes are on high income, right? This is your progressivity. But of course, I mean, if you don't collect a lot, regardless of this progressivity, you will not achieve a lot of redistribution, right? So this is exactly what is shown here. There are multiple ways to achieve the same redistributive capacity. On the one hand, you can have a system which is very progressive, but has relatively low size, what you call size of policy, meaning it collects overall little revenue. And on the other hand, you would have a tax system which collects a lot, which are relatively less progressive, less concentrated on high income. So the message here, you have a diversity of combination of these two components of redistribution, and it is very interesting to know what is driving redistribution, because of course, in terms of the reform you may want to advise, you would have very different messages, right? Do we need to improve progressivity, or do we need to improve the overall revenue collected by the tax instrument? Here the PIT, right? So it's very important to decompose that. Now, on the right hand of the screen, you would have the same message, right? Comparing three groups of countries: advanced economies, emerging markets, and low-income countries. What is interesting is that in a very large number of, in fact, low-income countries, you would have high progressivity, right? Meaning that in theory, when you look just at the progressivity, the tax schedules are indeed concentrated on high income. The thing is that there's just not enough collections, right? And what we call the size of the policy is just too small, and you will end up having relatively low redistributive power because it's just too small, right? And the opposite happens. The opposite happens with the advanced economies, where you have relatively less progressivity, as measured again by this CAC 1 index, But because the PIT typically in advanced economy just larger, right? You collect more revenue. At the end of the day, you will achieve much more redistribution. And again, I insist that this is all done controlling for pre-tax redistribution. So these are accurate comparisons we're making here. I'm almost done. One last slide, please. And so just to wrap up, right? So we have a very rigorous method invented by Dardanoni and Lambert, the transplant and compare method, which is unfortunately very demanding in terms of data. This simplified approach make it work for many countries where you don't have micro data, and it is useful to measure significantly and to compare in a meaningful way, compare tax system. Results that we have on our application on the PIT is that the policy size in many low-income countries matters a lot and more than progressivity. So if you really want to achieve redistribution, you may want to distinguish very carefully what matters more, size or progressivity or both, right? Just one last point. This technique can very easily be used in transfer policy, right? Means-based transfers, as long as you have a transfer policy which is based on individual income information, the technique is the same. And again, we use that technique and other similar techniques a lot in TA work where you have microdata on the country you work with, but oftentimes you don't have microdata on the benchmarking comparator countries you want to benchmark your country with, and this is where this technique and similar techniques can be very useful. Let me stop there. Thank you very much.
Thank you,
yes.
Charles.
Yes,
I think we need to move on. Yeah, okay.
Yes, thanks, Chiara.
Thank you. I think we will distribute the presentations at the end of the conference, if you're allowed to share it. And but let me pass now to Jon. So Charles has given us, an alternative measure, especially when we don't have possibility or enough data for microsimulations, and interesting results, I would say, because it looks pretty effective as an alternative. But let's hear from Jon now, more on the use of CEQ and effective progressivity, but using CEQ. Yesterday, we had the pleasure to listen to Nora Lusting, and today we're looking at some concrete applications. Thank you.
Excellent, thanks. Thank you. Is this on? This one is on? Yep. Yeah? Okay, good. Thanks, Chiara. Thanks, Alastair, and thanks, Charles. Also, Alastair and Charles have both set the stage for my presentation very nicely, so I hope that some of the concepts and terms we can rush through in order to save time for Wynnona's presentation, which I'm sure is equally fascinating, if not more so than what we've already seen, as it's a practical application of some of these principles and methods for measuring progressivity in South Africa, which is an interesting case study to begin with, and therefore applying interesting methods in an interesting case study is bound to be doubly, if not more, interesting. By the way, I wanted to mention that there's no ideological or spiritual or emotional or even virological reason why I'm 2 meters away from the rest of the panelists. There happens to be a physical obstacle here. There's a server case. That's why I'm over here on the very left-hand side or right-hand side from your perspective, and also angled a little bit awkwardly. Apologies for that. I hope it's not disturbing anyone. I want to talk about in more detail how to measure effective progressivity, and as I mentioned, Alastair and Charles have already provided a lot of detail on the other measures of progressivity. So for that reason, I'm focusing on effective progressivity, but also I'm focusing on effective progressivity as that's the sort of measurement that we typically use or typically turn to when we're worried about the impact not only of revenue policy or tax policy, but also expenditure policy, the impact of fiscal policy on individuals and households on families, on working women, on children and the elderly, et cetera, et cetera. The effective progressivity measure is the one that we use in order to say whether governments are doing a good job, whether fiscal authorities are doing a good job of achieving redistribution or anyway getting closer to goals and objectives that they have with regard to equity via fiscal policy and social policy. So what do we need to measure effective progressivity? Well, let's define it first. Alastair did. I'll define it one more time. The effective progressivity of a particular tax instrument reflects the de facto, that is in practice, in application, tax burdens faced by individuals or households or whatever the taxable unit is against the de facto pre-tax incomes of those same individuals, households, and so on and so forth. What do we need in order to measure effective progressivity? Well, we have an indication already from Alastair and also from Charles of what we'll be relying on. We need a set of individuals and their taxable incomes or taxable consumption when it comes to indirect taxes. So we're thinking here about household surveys, budget surveys, income and expenditure surveys, some sort of micro data source where there's a set of individuals, representative individuals, and they give us some information about what they're purchasing or where they're earning income and how much income they're earning. In addition, we need a set of rules describing how taxes are extracted from those incomes or transactions. So now here we're thinking about the statutory rate schedules that Alastair mentioned, or we're thinking about statutory VAT schedules for indirect taxes, for example, or excise schedules, customs duty schedules, et cetera, et cetera. Or if we don't have the set of statutory rates, we can also look at confirmed or audited, if you like, distributions of actual taxpayers or actual taxes paid on consumption items. So if you have tax administrative data from the tax authority, then that can be used also to generate sort of an empirical an empirical rate schedule, even if you don't have the statutory rate schedule. And in cases where you have both of those things, then there can be some correspondence or some comparison between the statutory rate schedule and what the tax administration data, for example, is actually saying about the rate of income collected, the rate of taxes collected from certain levels of income. So I think so far so good. This is not incredibly exotic or not something that most of us are not familiar with. If we have these sort of basic elements, then we can start to put together graphs and indicators of progressivity of a tax structure or a tax policy that look very much like this. This is from an ODI working paper on informal taxes in Pakistan. This happens to be a graph of the income tax schedule or income tax statutory rates, marginal rate schedule in Pakistan. The reason that I put it up here is I wanted to use it briefly to demonstrate that there's a difference between having a marginal rate schedule that's progressive and the average rate of taxation, whether the average rate of taxation for individuals and households, and more importantly their incomes, is on average progressive for all levels of income. So the blue line, I think it's blue, the blue line here represents the marginal rate schedule. The red line that's above it represents the average tax rates by income level or by income amount, by taxable income amount. And you'll see that for tax brackets over which the marginal rate changes very slowly or doesn't change at all, the average tax rate for individuals in that tax bracket actually falls from the lower end of the range to the upper end of the range. So even though the marginal rate schedule is highly progressive, we can't say with any certainty that every individual will be paying the taxes that they are owing to the fisc in a progressive way, because there are some individuals in a range who will be paying more as a percent of their own pre-tax income than other individuals who are richer, according to pre-tax income, in that same range. Anyway, this sort of graph can be produced with exactly the data sets or the combination of data sets that I mentioned in the previous slide. One advantage of effective progressivity, or looking at effective rates of taxation, is clear, or I hope it's clear. The micro-level accounting that we're doing by using microdata combined with tax schedules or tax administrative data is necessary for valid estimates of the impact of these same taxes on poverty, on inequality, other welfare indicators that we might care about, purchasing power, and then also for specific population subgroups. So I mentioned working women, but there are also individuals living in remote areas or individuals who are involved in subsistence agriculture, for example. We might care specifically about the impact that tax policy or revenue policy is having on those specific subgroups. So effective progressivity or measuring effective rates of taxation are precisely what we need in order to be able to produce the graphs that show the impact of fiscal policy on indicators like inequality, on the Gini coefficient, on indicators like poverty or the poverty headcount ratio or the depth or the severity of poverty. Effective rates of taxation, calculating or estimating those individual by individual or household by household are necessary to put together these kinds of benchmarking tables, which are different from the benchmarking tables that have already been mentioned. These show the impact of fiscal policy and within fiscal policy, tax policy on individuals and households, and then therefore on rates of poverty, on measures of inequality and other indicators that we might care about. That's the advantage. The disadvantage, and this is one where methods mentioned methods discussed by Alastair and Charles are better, is that the disadvantage of effective rates of taxation is that it depends heavily, or it depends completely actually, on the sorts of information that we're getting from the microdata. And in particular, in microdata sets, in high income settings and low income settings and middle income settings, there are, let's call them deficiencies or gaps in the data collected, gaps that are critical for measuring the effective rate of taxation across all individuals. So one very well-known gap is that individuals often underreport income. And that's more frequently a problem at the higher end of the income distribution. And the magnitude of the underreporting is often higher at the higher end of the income distribution. Also at the higher end of the income distribution, of course, is where the majority, a plurality, and certainly a majority, often a plurality, often much more than a plurality of tax revenues, from the point of view of the fisc, are coming from. So this presents a problem right away. We know that in microdata sources, top incomes will be underrepresented. In fact, there may be some top incomes which don't appear at all. There may be some representative individuals who refuse to answer the survey enumerators who come around and ask them to start sharing their income tax records or their wage and salary statements. Another problem that we face is that the individuals in the microdata, even ones for whom we have good records or good information on whether or not they pay taxes and how much taxes they are paying, they may not match the individuals in the distribution of actual taxpayers in the tax administrative data. So sometimes we have individuals who confirm that they pay taxes, but their incomes are so low that we wouldn't be able to find that particular individual in the tax administrative data. So some people with very low incomes nonetheless report paying taxes. They report paying taxes on incomes which are so low that they shouldn't be appearing in the tax administrative data. So that's another, it's related to income underreporting, but it's fundamentally a different issue. So in such cases where either of these deficiencies or data gaps occur in the microdata, these cases happen far more often than not. Our ability to use the microdata and effective rates of taxation to measure overall fiscal position, so from the point of view of the fisc itself, cannot be done. We're missing some of the individuals and more importantly some of their incomes, some of their consumption transactions, which make contributions to the overall fiscal position. So if we're using effective rates of taxation to have conversations with ministers of finance about what are the likely revenue impacts of a particular reform, to personal income tax schedules or VAT schedules, we're probably barking up the wrong tree. Better to use other methods for that kind of discussion. What can we do in order to get around some of the disadvantages that we've just been talking about if we're still interested in estimating effective rates of taxation? We may be interested, again, in estimating effective rates of taxation because if we have those effective rates of taxation, then we can begin to say something intelligible about the impact that fiscal policy is having on individuals and households. So I think this is actually now a repeat. There's some additional difficulties when we're talking specifically about, for example, PIT, personal income taxes, and some other specific difficulties that we encounter, which are even hurdles even more difficult to jump over when we're talking about corporate or capital income taxes. And in fact, corporate income taxes and capital income taxes is a discussion for another day when it comes to effective rates of progressivity for all of the problems and deficiencies in the data that we have to rely on that Alastair mentioned earlier. But we're happy, I think, as a panel to take questions about what can be done in cases where we'd really like to be estimating burdens from corporate or capital income taxes, but we simply don't have the data set necessary to do it, to put together a reasonable estimate. So what can we do when some of the data that we would like to have is missing? The next couple of slides present practical solutions. They don't get at, or they don't provide a solution for the disadvantage of not being able to say anything intelligible about fiscal positions, but they do provide a better way, or a way of being more precise about the impact of taxes on these other variables that we care about. So household and individual level variables like poverty, purchasing power, and inequality. So for indirect taxes, it's relatively simple, and through the application of CEQ assessments and other fiscal incidence analyses over the last 10 years, 15 years, we've come up with a tried and true method for estimating the impact of indirect tax, the effective rate of indirect taxation on all consumption transactions. The way we do that is to apply some additional data that describes how taxes on inputs cascade through production processes and end up being embedded in the final price of consumer goods. So input-output matrices are exactly this description of the production processes which we use, and we feed data on, for example, VAT and excise taxes into an input-output matrix to discover then what the likely burden of those input taxes are on the prices, or on final consumers via prices paid. Why is that important? Well, here is a look at the impact of VAT, both the direct effects and the indirect effects in Zambia. This is from the Zambia CEQ assessment from 2015. And I'm going to shrink this scale on the x-axis in order that, the y-axis, so that we can look at what's happening in the lower deciles. In the lower deciles, the direct effect of VAT is smaller than the indirect effect of VAT. So the indirect effect of VAT arises when there are exemptions or special rates or zero-rated goods, but nonetheless, some of the VAT paid on inputs is embedded in the final price of goods paid. So in fact, there are so many exemptions and special rates in Zambia that the indirect effects for consumers in lower deciles are actually larger than the direct effects. This would apply equally to something like carbon tax, where the direct effects for example, in places like Ethiopia and Ghana may be very small, where for lower income consumers, but the indirect effects might be comparatively larger. Here is the same sort of analysis, but for subsidies in in Zambia, so I'll pass by. For direct taxes, and in particular for personal income taxes, there are also solutions, and Wynnona will be covering one in greater detail, so I'll rush through till the end here to get where, so that Wynnona can speak. The easiest, or the method that we've had the most success with, is to take advantage of the administrative data that exists. So the administrative data that exists is very detailed on the distribution of incomes and taxes paid for the set of taxpayers. And we can combine that distribution there are a few different ways to do it. We can combine the distribution that we see in the tax administrative data with our distribution of households from our regular household budget survey or income and expenditure survey in order to get more precise estimates of what the impact of taxes is, all up and down the distribution, but also what the overall impact of taxes is, for example, on Gini coefficients or levels of poverty. So this is the end table in an application in South Africa, different from the one that Wynnona will be talking about, which shows that after we incorporate the tax administrative data, not only is pre-tax income in South Africa more unequally distributed than we assumed, or that we estimated, but also that the impact of direct taxes, the personal income tax in South Africa, is actually greater than had we not taken the trouble to look at the tax administrative data and the distribution of taxpayers and income in the tax administrative data. So it's a bit of it's not a mixed message. It's showing that underreporting of income leads to underestimations of Gini coefficients in most cases, and that the other disadvantage of underreporting of incomes is that we don't estimate the true magnitude of the impact of direct taxes on those incomes, which are more unequally distributed than we thought. So I've taken up more time than I was allotted. Apologies for that. I will end there.
Thank you, Jon.
Hi, thank you. Thank you so much and for sharing all your expert knowledge. I've prepared something, but after going through everything that was said this afternoon, I think I'm just going to try and link on to some of the discussions that we have and just take it through to South Africa. South Africa is known for a very unequal distribution of income. We have a very high Gini coefficient, I think almost the highest in the world. We also rely very heavily on personal income tax. It's close to 40% of our tax revenue that we collect. And we also have a very progressive structure with a high marginal rate of 45%. And so you will think is as well, we've got a very redistributive tax system, and that we actually, what we've seen with the past few years with budget proposals that has come through is that we haven't seen the revenue following it and coming through. And some are saying is because of behavioral effects. Now, I must tell you that currently we have quite rich microsimulation data, tax return data that we can access. But I must tell you that that is also very recently. We now have just done a PITMOD microsimulation model for the 2018 tax year, and we're actually now updating it to the 2021 tax year. And I think we'll have in the full COVID impact also seeing that. So what I just want to say to you is that before we had this access to this very large microsimulation data set that we've just completed last year, we were also very much in the dark in our analysis of how progressive are our tax system. If we do make tax policy changes, where will it be, where will the revenue come from, and how will we change the different measurements that we've just heard about progressivity. Perhaps I just want to give some insight to link to Jon and Charles and Alastair, is that our survey data, survey data is not done on an annual basis. It's done with intervals. So you will find is that it could be like 5 years intervals, then it gets like a weight-based sample that's then operated to a population. And what we have found, because in South Africa we've got such an unequal distribution of income, that the last decile will actually be the personal income taxpayers. So just imagine if you want to do any decile analysis on progressivity of your tax system, you only have the last decile. So, and I think they've split it like in 4 semi-components there. So it's very, very limited to work on survey data that's every 5 years, that's got very limited information on the distribution, because we've got such an unequal distribution where very large numbers of our citizens actually have no or little income. And then lately, we've also been asking if we have to go to a basic income grant for those that are unemployed and currently not being supported by the a benefit system. We've also got a model microsimulation that's based on the survey data and that are based on expenditure data, and it's also complemented by income survey special data that are done more frequently to see if we aren't actually that underreporting of income, so that when we do tax benefit analysis in with the survey data, whether we are able to conclude to more proper formulation of policies that will have the desired impact that we would like to have. But coming back to our tax return information, and I want to specifically here link to Jon, is that we've got now detailed tax return information where taxpayers have filed their tax returns, and with the modernization drive that we have, we've now got access to all that information in the returns. But you will now think, well, now they're in a happy position to actually do all that they can do, but no, it's not the case. And why is it not the case? Well, we've got about 21 million when we look at the 2018 tax year taxpayers. And of the 21 million taxpayers registered, and why it's so high, because even if in South Africa you want to apply for a job, you have to be registered. So we've got many taxpayers on record, but with no income. Secondly, what we've seen is that with our latest analysis of the data is that we've got about 14 million taxpayers that do derive income, but only close to 6.82 million of them are paying tax. So can you see now we've started with 21 million, we've come down to 14 million, and now I'm telling you only 6.82 million is telling us they are showing that they are paying, that they are liable for tax. Secondly, I think it's also important to remember is but how are you then, what are you going to analyze if you want to look at the progressivity of your tax system? So what we have done is we've now combined our tax certificate information. Those that get tax certificates who do earn an income but are not paying tax, and I think it's coming to Jon's point that why are they declaring that they're paying tax but you don't see them? Because they don't need to file. So our threshold for filing is 500,000 per annum if you're not the director and you only have got wage income. And by the way, wage income is about 90% of our pay-as-you-earn is about 90% of our personal income tax. So wage income is the income that is earned by the majority. If we look at the capital income, it's only a very small percentage that are declaring capital income and passive income and interest income. I think our tax liability progressivity Gini coefficient is 0.82. That shows you it's a very progressive tax system. You will tell me we can't do anything anymore here. But you'll see if you do want to come and listen to our paper tomorrow, what we have discovered is what Alastair was saying is that if you set your threshold too high, you might be capturing too little people at 45%. And then secondly, 48% of those that are earning an income in South Africa are not paying tax. So I think even the minimum tax threshold is too high. But what will happen if you look at our normal distribution of taxpayers is that it's actually centered around low middle income. So if you do anything to the tax brackets or the tax rates where that normal distribution is peaking, it's actually costing you a lot of money or you're gaining a lot of revenue. And that's also coming back to analysis that we have here seen, is that it's also quite important if you look at your structural progressivity and you combine it with your distribution of your taxpayers, you might find that changes the whole picture that you've seen in your structural progressivity. And I think is that this analysis that the World Bank has shown us here is really very important because it covers all those different aspects. And if you don't do that in combination and you don't take into consideration what data are you looking at and how you have to supplement that data. So what we do is we take all our ARP5, those that have had a deduction in tax. We take all the IT3 tax certificates, that those that are receiving an income but are not paying any tax, and we take all the tax return and assessed information to actually determine exactly who are paying tax, who are below the threshold, and how's the bunching of those taxpayers at the different marginal levels. And like they explained, if the longer your income brackets are, actually you could see is that if you look at the slopes of the lines, that you know that it's actually far less progressive than what it will be at the beginning of the tax bracket, or even after the tax threshold. I think what I just want, there's one point that I wanted to make still, is that also if you look at the different sources of income and the different deductions, and you look at your tax expenditures, I think there's still plenty of room for South Africa to make sure that we've got a more progressive system, having more income, and not only looking at those that are paying tax, but also those that are receiving an income against those that don't receive any income. Just to give you some proportionality on the numbers, is that we've got about 18 million people that's dependent on social grants. So if you tell me that 14 million is receiving an income, only less than 7 million are paying tax, I think it needs to have a relook at the total distribution of income and tax in South Africa. I think I'm going to stop here, because a lot of the stuff that I wanted to tell about, I perhaps just want to say our survey data in South Africa is done by Fieldworks. It's unfortunately not electronically done, so it's not as good data as that you get in other parts of the world or the more developed. I know that many institutions and councils are using quite successfully survey data. But if your survey data is really under-reporting of a lot of the elements that you need to examine your tax structure, then that put actually a break on the analysis that you want to do. Perhaps I can just say that before we had the modernization and all this information that we are currently having, just a good analysis of the structure that you have without the distribution is a starting point. And I would say that the second thing that I think, given that we now in a high inflation environment, I know that countries in Africa or in the developing world was quite spared of inflation. So what you'll find is that if you don't do those adjustments to the brackets, you might change the progressivity of your tax system unintentionally. And secondly, you will then impact on, like we've John seen, on the expenditure side of the budget and the VAT, what happens to the VAT system, because you're actually constraining those consumers, and you're actually placing a higher real burden on them than what you are intentionally saying in terms of policy terms. So I think that is also a very important element to always take into account when you do analysis on your tax reform and how you adjust your structural brackets and income system every year. I think I'm going to stop here. I hope I haven't taken up too much time.
No, you're being wonderful and effective, I think. So I think I just want to wrap up. First of all, I think these 4 presentations are a great example of the importance of research and analytical work. Because as you heard, as they start, I think South Africa is a wonderful example, starting to investigate, came to some conclusion, investigate deeper, the conclusion about the progressivity of the system changed. And then more as there is analytical work efforts together with Wynnona, there are teams and also people that are really committed to this agenda of assessing the progressivity, the true progressivity and effective progressivity of a system. It requires a lot of also data, infrastructure. So it's a part of a development agenda. And we are at the tip end with fantastic research and analysts, but also it's because there is an infrastructure that allows them to do that. So I think this is one takeaway, that it's important when we address these issues. It's also to assess how the institutions are organized, how data is collected, how creative can we be when we have little data available. But also I think what we learn is that let's not stop to the first analysis. The three presentations in particular showed different methodologies, important to be persistent, to compare them across and to see what is the consistency, what we can learn from the differences. And I think this is very important. And the third one is there are still a big agenda ahead of us on capital income tax, so taxation of capital in general remain. I think yesterday you heard Mick Keane at the very first panel that he said, I think we are still missing a theory of taxation of capital. And I think what he meant is that we really need to focus on it and we need to decide, is it personal income, is it capital income, are we serious about it? But also what we see, what we heard is that most of the data escapes from these tax records. And so there is, I see here, there is a big agenda in front of us to pursue. But having said all of this, I want to open the floor for questions. And they will answer. So there is also one here in the front.
Thank you. My name is Balint Van. I am from the Ministry of Finance of Hungary. And I have two questions. One of them is about incidence and measuring progressivity. So to me, it seems compelling that incidence should be seen and taken account, but at the same time it seems quite difficult. So I am more familiar with evidence about VAT, and there we see that incidence can be different for products and services. So then it would mean applying different for different product categories, but it can also depend on whether the tax was increased or decreased, which means the progressivity would depend on the history of the tax schedule. So what do you think of this, how to approach this whole issue? Because at the same time, if we say that everything is passed through to consumers, then we can have probably misleading results about progressivity. And my second question is, what do you think about the, should we measure the progressivity of social security contributions and other payroll taxes, and whether such an analysis should be done together with the PIT or separately? Thank you.
Okay, thank you. And there is a question also here on at my left.
Hello, I'm Grégoire Rota-Graziosi, professor here in Clermont-Ferrand. I have two questions. One, I'm surprised you don't mention property tax. How you deal with this? Do you take into account the fact to be an owner? And you know, in some countries, we have some fictitious income to be an owner of your the apartment. So there is also the taxation, the potential taxation of in-kind advantage provided by the firms. And how? And my second question, which is tricky, huh? I don't have the reply, of course. How you deal between CIT and PIT for physical person doing businesses?
Hi, Ross Warwick, IFS UK. So my first question was also actually about incidents, so I'll just kind of build on the first question over there to ask about incidents, especially in developing countries, with something like VAT, where there's, well, at least as far as I'm aware, no good evidence about whether the incidence of VAT is different in developing countries in the presence of informal markets, and whether that varies across the income distribution. So anything you can say about that, and kind of knowledge gaps or ways forward there would be interesting. And my second question is maybe more actually related to the session yesterday about the redistribution of the whole fiscal system. I was just wondering, so in higher income countries, most of the redistribution of the fiscal system is not from rich households to poor households, it's from working age households to children and to retirees. So does the demography of developing countries here affect these fiscal incidence analysis? I'm just trying to think it through, but in countries where the dependency ratio is lower, my thinking is that this should structurally reduce the progressivity of the fiscal system. Is this something that anybody's thought about? Is there a way that we could kind of control for this in these analyses? Very open question, and I might be completely off the mark there, but.
I think we can stop here. Thanks. Shall I give the floor to Charles maybe first?
That's easier.
Charles.
Thank you, Chiara. Yes,
Do you want to take the incidence questions? Yes, go ahead.
I think that the incidence question maybe is for my colleague Alastair, I think in particular. I would like to take on two questions on progressivity and social security contributions, and let's start with that. Yes, it's a very good point. Yes, the answer is yes, absolutely. Social contributions are very important, and they make a substantive part of the, of a share of the pre-tax income. So the answer is yes. Ideally we would want to do that, but if we do, of course, you may want to have to take into consideration the spending part of the system, okay, and that's harder. Yes, try and do that on the purely revenue side, but if you can, try and take into account the income, the means-based spending that is associated to that. And this relates very closely to the second question, a very good question that was asked on the intergenerational redistribution, right? Absolutely. And what we have discussed, I think, the four of us, I think, today, is in fact a static view of on a yearly basis, right? How much redistribution we achieved in a specific point in time. But it is absolutely correct that a broader perspective is lifetime income. Okay, what kind of redistribution you achieve for individuals or households over the whole lifetime, including, of course, the period during where they are retired, they retire, and they get pension payments. So yes, that would be another area for research, and that would be very interesting. But I mean, given the challenges that have been discussed today, my personal take is that there's so much work on the static short-term immediate impact in terms of distribution that all of this is already very challenging. Let me stop here. Sorry, the property tax, absolutely right, very important. This is direct taxation, similar to PIT. Grégoire is right, and it is certainly a very powerful instrument of redistribution. Links back to Chiara's remark on what about do we do with wealth redistribution. It's very closely related, but I completely agree it's a very important point too.
Thank you. Why don't we start with Jon and we move towards Wynnona.
Sure. So there were all of them interesting questions, and I'm going to pick and choose the ones that I'd like to respond to, and then the others can can scrabble over the rest. The question that Grégoire put about CIT versus PIT for individuals or micro enterprises run by, for example, families or households is a very good one. And pertinent in exactly the sorts of settings where data is anyway difficult, and determining the incidence of all the other taxes is anyway difficult. So far in the studies that I've participated in, and various co-authors of mine have also taken a very practical approach in separating corporate income tax on, say, micro and small enterprises that are typically run out of a single household or among a single set of related individuals as personal income tax. Not so much on on wages, but as a personal income tax that directly affects income earned by contributing one's labor in the marketplace. Yes, you're contributing it to your own business. Nonetheless, it functions as a personal income tax does for those individuals who pay personal income tax. Also, this sort of distinction between what a fisc might call, or what the tax administration calls a particular tax, and what it actually ends up, the impacts it actually ends up having in real life, is an important one. So I remember in India when we were trying to work out the impacts, the incidence of all the different indirect taxes that the Indian federated and states, federated organization and states have and can apply. There were instances of something being, an indirect tax being called a VAT when in fact it was functioning as a sales tax or an excise tax, and vice versa. There was a sales tax, a GST, that was actually functioning as a VAT system, and then that differed as well by whether it was services or goods that were being taxed. So that comes back to the first question as well. Yeah, we have to be aware of not what the tax is named or what the statutory schedule says for particular sectors the rates of taxation are, and whether or not there then are refunds in there, but what's actually happening in practice. So in Vietnam is another good example for the indirect tax system. There are apparently backlogs in the refunds being given to people who make claims on VAT input taxes. And that then functions as, it sort of breaks the logic of the VAT system overall and makes us wonder whether the VAT system in Vietnam is effectively functioning as a regular old sales tax. So those differences in operation are critical, and if you're doing incidence work in order to measure the effective rates of progressivity or just the effective rates of taxation to begin with, then you want to be aware of those operational differences. I'll stop there. I think the other questions are interesting enough. I'll let others respond.
Thank you, John.
Okay, I think incidence was pushed to me, so that's a good start. Yeah, as I mentioned in my presentation earlier, incidence is a huge issue. If we think about the bank and the World Bank and the IMF had a joint conference a couple of weeks ago, just talking about the use of tax systems to potentially to help address the spikes in energy and food prices, and so an obvious thing people start talking about then is, well, give me where are our reduced VAT rates on food. But a very good point that was emphasized there by Professor Rita Alferia was exactly this incidence point, that it's not just, there's no guarantee that if you reduce a VAT rate that it's actually going to be passed on to the consumer. Now, of course, even if it is passed on, if you do the incidence analysis, you'll see that reduced VAT rates are very poorly targeted at a bad mechanism of trying to target low-income and poorer households. But I mean, that's a 2-hour discussion for perhaps another time. But it does emphasize that incidence point on VAT really is crucial. If you look at the theory, you can have, depending on the market structure, you can have less than full pass-through, you can have full pass-through, you can have more than full pass-through, again, depending on certain types of sort of oligopolistic competition. Then you look at the theoretical literature, and it's a little bit mixed. I mean, the empirical literature, we all basically make the same assumption. We assume full pass-through, and we do the analysis, because basically it's remarkably difficult if we don't do that. What happens if we don't assume full pass-through? Then we have to ask, well, okay, if it hasn't been fully passed through, who is it borne by? And then we don't have data in terms of trying to allocate those taxes. So just from a computational point of view, there's been a little bit of a simplification made in the literature for VAT, just to assume full pass-through. But yeah, the commenter was making, yeah, the evidence shows. I've seen between 30% pass-through, estimates 70% pass-through, 80% pass-through, varying quite significantly in the empirical literature. And also, you know, a couple recent really interesting papers showing exactly that if it's that a VAT rate increase will be immediately passed on to consumers, a VAT rate decrease will take a long time before it's, you know, effectively passed on as well. So all sorts of issues around that. Property tax. I mean, I did briefly mention property tax in the sense that in some surveys you will report the actual property tax paid, and then that can help you to do distribution analysis there. But incidence is a key issue here as well. I mean, this is another area, like the corporate income tax and property taxes are two areas where there is no definitive answer in the literature. There really are still question marks there. So with the property tax, I mean, there's, you know, this is a local tax. It's is this, you know, there's the benefit tax idea. So if this is a payment for local public services, then arguably there's no distributional impact. You're paying effectively for a service you're receiving. I mean, the more typical view is that it is borne by capital owners, by the owner of the house, and in that sense, on the basis of that assumption, then it's a progressive tax because it's wealthier, higher income individuals, families will more likely to own a house, will own a more expensive house, and therefore are better off, and therefore pay more tax if you impose the property tax. But again, if part of the tax is passed on to renters, you know, you can potentially have different distributional effects. So really, that incidence question, I mean, that's really hit the nail on the head. That's a really key question with some of these issues. The one thing I would say on that, though, at least with the personal income tax, we're broadly confident that that's passed through to workers. The SSC, the Social Security contribution question, I thought was really interesting as well, because you then have to ask, well, okay, you've got an employee social contribution. You assume that that's fully passed through to the individual. What is the assumption with regards to the employer social contribution? Is that just being fully passed on in terms of a lower wage as well? So there's issues around incidence with social contributions. Beyond that, even if you assume full pass-through, the impact is typically regressive purely in terms of the taxes, because you will have often countries will have an upper threshold at which the social contribution is charged, and so high income, and so at some point on the income distribution you will stop paying contributions. Now, typically that's because there is no longer an actuarial link between your contribution and a future expected pension payment. But if that actuarial link is relatively small in the first place, then it may really be very close in the nature to a pure tax, in which case that threshold really does, that maximum threshold for the contributions really does create significant regressivity, and then countering the progressivity of the personal income tax structure itself. I will stop there because I'm talking too much. Wynnona.
I thought women were always talking too much. Well done to the team, I must tell you. It's fascinating listening to you. I think I've now scribbled just down, it's in no particular order. I just want to say, usually when you look at personal income tax, it always excludes taxpayers that are incorporated and then regarded as corporate income taxpayers. But you can have professional people paying personal income tax, partnerships paying personal income tax. So in our tax system, we also have, you can declare business income, you can deduct deductions. So it's not only wage income or passive income or capital income. So the personal income tax system actually do cover business income. And then taxation in kind, we tax benefits. So if there's no money involved, because if you structure your tax system to receive a benefit rather than in kind, rather than having money. I think that already happened in most of the tax systems in the 80s or 90s, when people were structuring their tax packages to limit the tax that they have to pay. So benefits are taxed if it's declared, and mainly in the formal sector. I think that is the case. And then history of schedules, of course, yes. I think if you want to change the progressivity of your tax system, if you want to change tax rates or brackets, or you want to do something, you have to take into account what currently is your tax burden. You can't suddenly, you can lower it, but I mean, you can't suddenly increase it. We had real relief given in the early 2000s when we did base broadening, and it's so dramatic that you could see the structural break in our personal income tax system. But I mean, everybody was smiling because although we were broadening the base, everybody could see real relief coming through. And so, but I mean is that if you have, like South Africa, a very high concentration of taxpayers, you can clearly see also how our rates and our brackets are not aligned, and that is because of the revenue impact. And if you do anything at the lower middle end, it's really costly. So I think your history comes through, and you have to take that into account if you want to do any reform, and you might have to do it over a number of periods. And then just perhaps to say is yeah, I think the informal markets and the VAT was dealt with you can't claim it back, and then you see it as a, you know, it's like a general sales tax because they can't claim the input tax. And then I just wanted to say is also South Africa's got a individual tax unit. We're not discriminated against women anymore. What we did, we had our women that were working had the highest tax burden, and I know of couples that actually got divorced to escape that marriage tax that we went through. We were also taxing married men the least, and it's assuming that women are not working, and if they work, they shouldn't be working, and they should take care of the children, and married men has got the most expenses, and unmarried persons then will just be after that. But women were actually taxed the highest. So when we became a democracy in 1994, there was a clear mandate that we have to reform the tax system, and the unit is the individual. And so we don't have child credits, we don't have home credits, we don't have any of the credits that you find in many or two-tier systems, and this kind of system and this system. And I think for simplicity and for and then looking at horizontal fairness and everything, it just makes it less complicated and more fair than having all these lots of systems that I think the OECD countries still have. Thank you.
Some of them at least.
I'd just like to take a moment to follow up on what Wynnona just said in regards to Ross's question about demography and the impact of the tax system or tax policy. There's some interesting results that are beginning to trickle out of a study that we're doing with the World Bank, actually, on the incidence of fiscal policies and gender equity in particular. So there are countries that are still like South Africa in the sense that tax policy disadvantages what is called the secondary income earner by taxing that income at a much higher marginal rate than if it were joint income, that if that income was taxed jointly. Sorry, the other way around. The indications that we're getting is that countries with tax policies that disadvantage secondary income end up creating more inequity between genders, in the sense that there aren't incentives for women to enter the workplace, and therefore they spend more time in traditional roles taking care of children and other dependents, in particular elderly dependents who need a lot of care, but who also might be, those same elderly dependents might be bringing in pension benefits or other old age benefits that they qualify into the household. So I can't off the top of my head work out the algebra, but it would be interesting to see in practice whether higher dependency ratios or a greater gap between dependency ratios in the bottom decile versus the top decile means something for the progressivity of tax systems with respect to income, but then also combine that with a look at then what it's doing to gender equity. So thank you for that, the information.
Thank you. So we are beyond time, but this is a fantastic panel, and you can see the passion. And we will maintain this level of passion as we move forward because of all the issues that also some of you have raised. And thank you. It is a true issue for development, and not only for development, also for developed countries, as you know. So it's something that we all have to work together. And so thank you very much. Charles, thank you also for spending time with us virtually. And a big applause to the panel, and I hope to see you soon and see you tomorrow.